All right, everyone. So today we're going to be talking about the psychology of market cycles and how retail traders get played. Again, if you see me looking down and looking up, as I always say, because the masterclass is happening right here with the people on this call, and then I'm also talking to you, the audience on YouTube.
Trading is a mind game. You heard me. Trading is a mind game.
Now, listen, if you are a trader and you come across this video and you are not able to discipline yourself to listen to it till the end, then it means you have not come to the awareness of the information that you are coming face to face with. So you have to discipline yourself. The videos comes in its quality. I try my best to make sure it's well, delivered in any way that I can. But then discipline yourself and watch the videos till the end. And don't just sit down to just listen. Take notes. It's very important. If you listen to the videos I'm about to start uploading every single week on trading psychology, your psychology as a trader can really be improved. Just try it for the next 90 days. Every single video I post on this page as a masterclass, watch it and see how you get transformed. Believe me. As I said, today we're talking about the psychology of market cycles. Please write it down. The psychology of market cycles. In other words, how retail traders get played. You see, the first thing that needs to come into your mind anytime that you are asking yourself, what are some of the things that drive the market movement? There are supply and demands, and there are other fundamental factors that drive the markets. But one thing that I will say that you need to also know that drives the market is the system. Well, let me call it a system. Emotions. Please write it down. One of the things that also drives the market, as in when we are talking about the structure of it, is also emotions. It's very important that you understand that. When you understand that emotions also drives the market, it makes it much more easier to understand that, oh, hey, then if Cliff is talking about emotional intelligence, then it's very, very important. And if I say that how retail traders get played, I'm not talking about that every retail trader is getting played. I'm talking about those without a lack of understanding when we talk about emotional intelligence. Now, before we talk about that, and before I share my screen for you guys to just see what we have here, there is one thing I want you guys to understand, quickly, that in every single part of this journey that we are in here, there is something very interesting that people need to understand. That there is a hierarchy in anything that moves in a successful way or anything that is well structured. There are, in other words, authorities. There are hierarchy to that set of structure. Same thing here in the industry called Forex or the financial market. There is a hierarchy. And you may have heard me saying this, or you may have read it before somewhere, that at the top of the hierarchy, we have the major banks. They are the ones that are responsible for monetary policies and, other couple of monetary decisions in your country. They do a lot when it comes to the monetary stuffs in your country. Then we have the EBS. The EBS is the electronic brokerage services. Then the third on that ladder is what we have, the medium-sized banks. Then we have the fourth in chain command. We have the hedge funds. We have the private corporations. We have pension funds. We have, individual investors. We have companies like, the big companies, you can name them all. Then at the bottom of the hierarchy, we have the retail traders. Now, one thing that you need to understand is this, is that every one of these participants or players within the industry have emotions. Why? Why would you say that, Cliff? Because think about it. Every single one of these institutions have human beings behind them. Is that true, guys? Yeah. So every one of these institutions have human beings behind them. So that means that if the banks will collapse, and they could collapse because human beings are making decisions in the bank. There are hedge funds that collapse. There are hedge funds that can go down because human beings are behind these hedge funds. So you need to be able to understand that at the end of the day, there are a couple of few things people always don't understand. They think if you are a successful trader, then you don't have emotions. No, you have emotions. Same as the bank. So you hear stories of a bank, named Silicon Valley that collapsed because there are human beings behind that. So both the retail traders at the bottom of the hierarchy and the people who are the higher hierarchy, both of each and every single entity get emotional. The only difference is that when you get emotional as a retail trader, it affects your pockets. But when the big boys get emotional, it affects the market. Let me say it again. Every single time that you get emotional as a retail trader, it affects your pocket. But every single time that the big boys get emotional, it affects the market. So everybody is emotional. The question now becomes, how is it affecting you? Are you guys with me? How is this emotion affecting you? It is very, very, very important that you understand exactly what we are talking about here today. So don't say, "Oh man, I'm not a good trader." And if I ask you why, you be like, "Because Cliff, I am being emotional." Everybody does get emotional. The question now becomes, how are you allowing it to affect you? Is the bigger picture that you have to be looking at. The emotions that you see in the market that you have, that everybody else is having, is what forms the market structure we keep on talking about. Because your emotions goes high and it comes down. Sometimes it can go all the way low. Have you ever woke up one morning and you don't know why, but you don't feel like doing anything? And you go like, I'm low today. I feel low. You said that before. You are like, I'm at the bottom. I feel, and there are some days you wake up and you're like, oh my God, today is going to be great. Woo, let's go. I'm going to just kill it all. Right. So as a human being, your emotions can be up and your emotions can be down. And you need to understand the same thing as the market. Why? Because human beings are behind the market. It's not every single day that a guy that you see him as a goat always want to feel like trading. It's the truth. So everybody has different emotions. However, today we're about to talk about a specific type of emotion that runs in circles. That means that people feel this type of emotions or feel this type of way every single time in the market. And it has been a repeated patterns. Remember, we studied about the psychology of patterns. So it has become a repeated pattern to the point where that these patterns have now become very well structured in a way that you can predict the pattern. So the last masterclass that we had, we're talking about the psychology of pattern recognition. That means in order for you to predict any pattern, there should be a level of some repeated or regular, data that you can use. Same thing when it comes to the human emotions as well. Now, we're going to break this kind of emotion discussion into two areas. I call one from the disbelief to the euphoria stage and from the anxiety to the depressive stage or the depression stage. Now, the first thing we're going to talk about is disbelief. The market structure, everybody keeps on talking about. Like, for example, if you go to your trading view, the market structure that you see over there as a structure of the market is nothing but a mixture of emotions that is being represented by price. Or in other words, let's put it this way. It's price represented in emotions. Are you with me? So what that simply means is that every single time you see the market going up, it means there is an emotion pushing it. If it's coming down, there is an emotion pushing it. During the psychology of pattern recognition event, I spoke about this. I said that if the market is going down, it means that there is fear in the heart of the investors. If the market is going up, it means somebody else somewhere is getting greedy. It's as simple as that. When you understand this psychology, it changes everything for you. So number one is either you are afraid or you are greedy. Two things in the market every single time that you are making a serious decision. But then today we're going to be talking about the cycle of that psychological thinking about retail traders. The first stage in every beginning stage of every market, I call that the disbelief stage. Well, I don't call it that. But then the psychology of a market cycle by the Wall Street cheat sheet says so. And it is true. And you're going to find out that it's very true. Disbelief. Disbelief. Why is it that, why do you think people don't believe anything in the beginning by themselves? One reason, fear. Every single time you find somebody not believing in something, they are afraid what they are going to believe in may lead to regrets. Is that true? So every single person always will be like, hey, I don't think this is going to be it. The reason why they are saying that is not because they have gathered information and data to prove that point. They just don't want to be wrong because they are afraid. So they are like, ah, man, I don't think this is gonna work. So they are now being skeptic here, and then they are afraid at the same time, and that will cloud their judgment. It can happen in every single thing: investment, trading, picking the right stock, whatever one know. Or even your friend coming to you telling you, hey, you know what? I think we should start this business. And you'd be like, nah, I don't know, I don't know. You can even sometimes go like, I don't have money. And truly, maybe you may not have money, but sometimes maybe you have the money, but you just don't want to put in the investment because you are afraid what if it doesn't go well. So the first stage in majority of the times when it comes to the market, the psychology of a market cycle, the first bottom side is disbelief. A lot of people don't believe in that much. You can see it in you know, so many different market that was building up, whether crypto, even it happened in Bitcoins. You can use Bitcoin as an example. A lot of people didn't believe it was going to go up. Like, for example, the Nasdaq. People didn't believe internet was going to do anything. For example, the Amazon stock. People didn't believe that Jeff Bezos was going to be able to actually turn the internet into, or his website into a digital library. They didn't believe that. So disbelief is a very common initial stage for a lot of retail traders. Now, that is the first sign of an emotion that, not let me not even say retail traders, anyone can not believe, right? Depending on what is convicting you. The second one is hope. So as you guys can see right there, the first thing you're seeing right there is that there is a disbelief. So the person is not thinking this rally will fail like the others. All right. And then hope. Now, hope is where you have literally just, let's say, for example, you have marked up the charts. You know that, hey, for sure, this move looks like a move that is going to go up. But because you are afraid you might lose a trade, you didn't go into the trade. So what happened to you? You now kept on watching the trade, and eventually you started being hopeful because now, it looks like it's going where you said it will go. Now, the mistake that retail traders start developing is that they now start becoming the kind of people that they still hesitate to take the entry anyways. Number one, they didn't believe, even though they know this thing might go up. Let's say if you are marking up the chart. Number two, they are not being hopeful, but they will never take the entry because they are still having some petty doubt in their mind. Like, what if this thing doesn't go up still? So that is the hope. And I was saying this the other time, and I said, hope. When it comes to one of these things like hope can be bad and good at the same time. Cliff, what do you mean? There is a hope that came from believing in something, and there is a hope that can come from not believing something. For example, if you have $1,000 and you want to start your own bakery services, and then you know that because you are good in what you do, eventually an investor will find you and give you a couple of few $100, maybe 6, 7 figures, I don't know, to be able to expand your business. Now, being hopeful that way is a good hope that can lead to success. Then there is a type of hope that you never started the business and you are hoping that somehow, something will come from somewhere and then change your life. That kind of hope is not a good hope. It's a kind of hope that came from nothing. So you didn't take the trade. You didn't believe earlier. You didn't take the trade. And now you are being hopeful. What kind of hope is that? What are you hoping to see? You are never going to take the trade. So you don't take the trade. You hesitate on your entry. Then the next thing that you will find people doing, I won't call them just retail traders. It's not they become optimistic. Oh man, this is actually a buy as I thought. Duh. What were you thinking? You analyze it. You check the data. You didn't go in because you didn't believe in your strategy. You didn't believe in the system. You didn't believe the move was real. And you are right. It may not have went there, but that is not the point. In trading, it's not about being right. It's about sticking to a system. Are you guys with me? That is what trading is all about. Trading is not about being right. Why do you want to be right for? You don't want to be right. You just want to follow a system because you know if the system is working, eventually you will make money. So you didn't believe. You were hopeful, but you still didn't take the trade. And now for some reason you are like, whoa, this rally is real. I knew it. You started even telling your friends, hey, I predicted that gold will go up. Yeah, okay, cool. So what happened to it? Did you take the trade? If the answer is no, why are you telling me? Right? So you telling people I knew gold will go up does not necessarily mean that you are a good trader. No. trading is not about who can analyze. If you are an analyst and that is the only job that you do, did you know you need to also make sure somebody executes your trade with confidence because you are a good analyst? So a good analyst is not somebody who just say, hey, I think gold will go up, but it's up to you if you want to take it, if you want, don't take it. No, that is not how it works. That is not how it works. Even if you are just an analyst, you need to make sure somebody is at the other end taking your trades. Very important that we understand this. Very, 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 very important. So yeah, optimism. Hey, I think, and the mistake retail traders make here is that they now start becoming overconfident, right? They're like, woo, you know what? I think this is the move that I should have taken a trade. They keep on, they can tell people that, man, I predicted gold, and I was like, oh man, I didn't take the trade, because I didn't know, I was just afraid. There's nothing cool about that. If you are still afraid, in the Bible, they call a description of a believer who is still doing things like a child babes. Right? So you are still a babe in the market. It's okay. You're gonna grow, but you need to understand. Don't predict and run away and come back and be like, oh, I'm trading. No, you're not trading. Trading is a serious business. So you need to understand there are consequences to every decision that you make. Whether you take the trade or you don't, you're gonna pay for it emotionally. So now you didn't take the trade from when we're supposed to take the trade. You were hopeful, but you still didn't take the trade. You hesitated. Now you're optimistic, even though you didn't take the trade. So now overconfidence will now lead to increased risk. So now that person has now probably taken the trade from here, and he has also increased the risk because now he knows that if he doesn't increase the risk, he may not make more money. So he has increased the risk. Now, a lot of people are also saying, I think gold is going to buy. So now he's happy, they are happy, everybody is happy, like, oh, let's all buy gold. So now everybody is in gold. Now and he's not believing because he knows what he's doing. He's believing because he is the majority carries the vote kind of a follower. Because the time he was supposed to believe, he didn't believe. Why? Because he felt alone. But now everybody's talking about Bitcoins, so he wants to trade Bitcoins too. It doesn't mean that you know what you're doing. Even if what you predicted was true, those are not the qualities that make a trader a good trader. Does that make sense? It is very important that you understand that even though that you may have predicted that this is going to happen, because you didn't make any decision, you don't qualify to be called a trader, because a soldier is not somebody who identifies danger only. A soldier is able to mitigate a dangerous event. Then civilians don't need to be soldiers to know this is dangerous. Is that true? Yeah, if I see somebody holding a gun, I can smell danger from a mile away. I don't need to be a soldier to know that. A soldier is somebody, while he's staring at the danger, he's already thinking about how to neutralize it. So the neutralization of that individual and the way he does it makes us ask ourselves, are you in the military? Why are we asking that? Because there is something he did that is a skill. Same thing in trading. Analyzing is one skill, but how to execute and pull the trigger is another skill. A lot of people are not making money because they don't know how to pull triggers. It's true. Pull the trigger. If you think that this is a good trade, pull the trigger. It's as simple as that. So now you believe. You believe because a lot of people are following the same thing you're following. So you believe now. Then the mistake that traders make all the time, and most of the time, is they like following the majority a lot. And you see, one of the things about following the majority is that every single time you find thousands of people saying, I'm going to buy gold, there is a problem. You know why? Because every single time you find so many orders being taken from a specific area, it creates what we call pool of money. And anywhere that there is pool of money, what do you think is going to happen? The hierarchy is some of the players are going to see it and they will come and pick it up. There is an interesting story in the book, the famous book a lot of traders like reading, called Trading in the Zones by late Mike Douglas, and may his soul rest in peace. There is a story about a gentleman who was a good technical analyst and an investor who was a mogul in an investment, industry, basically the whole entire industry. He was a very good investor. So this technical guy came to the investor and said, hey, I can predict soya beans. I think it was soya beans. I can predict soya beans by drawing technicals on a chart. And I will show you that it will do exactly what I'm saying it will do. And then the mogul or the investor was like, "Are you sure about that?" He said, "Yeah, I have a track record," because somebody introduced a technical guide to the investor, and he said, "Are you sure?" He said, "Yeah, for sure. I can predict the market and it will do exactly what I knew it would do." He said, "Okay, cool. If that is the case, let's see." So the guy marked up and said, if the price gets to this direction, it will push up from here. And then the investor said, "Just like that?" He said, "Yeah, just like that." He said, "Nah, that is, by it, quote unquote, that is BS." And the guy said, "No, like for real." So when the price got there, the investor now asked the guy, "This is where you said the price will go up when it gets there." And then the technical guy was like, "Yeah, I told you." And then when he got there, it started to reject a little bit. So that means the guy wasn't wrong, but here comes the hierarchy. So the investor picked up the phone and said, "Sell me this X amount of the soya bean." It started going down, passing the technical side the guy marked. And then do you know what he was trying to prove to the guy? He was trying to prove to the guy that yes, you may be right. You can mark up the chart and know where price has the potential of buying or selling. But there is another side of the business that is called influence. And that is where a lot of times retail traders don't make peace with that. That you can predict the market so powerfully and then still be wrong, not because you are wrong, but because the timing, unfortunately, you met another kind of participants in the market that is stronger than you. That is why when we said we're talking about the hierarchy of the market is important that you understand that. You guys understand this now. That you can predict right, but you may end up being wrong, not because you are a bad trader, but because unfortunately you met the wrong participant in the market at that moment. So you being overconfident is not the right way to start your journey in the market. You need to always be humble, knowing the opposition as a retail trader at the bottom of the hierarchy. It's very important that you understand that. So after you start believing, you now become very thrilled. You are now like, "Hey, you know what? Um, this is it. I'm gonna kill it. Whatever or not. This is where we go for the home run." So you keep on even increasing your lot sizes, knowing that you're gonna be rich. Then the last stage from the disbelief to the euphoria is the euphoria. Now you are at the peak of the market, but then because you entered in late, you have made some money, but it's not really some good money that much. So you are hoping it will keep on going up. So now during this time, you are now greedy. And every single time that there are more greediness in the market, it means that the market is about to drop. And every single time there are more fear in the market is probably about to go up. That is why Warren Buffett said something. He said, "Every single time the majority is going into the market, I try to stay away. And every single time the majority is staying away, I try to go in." So it is all a strategy you need to understand, emotionally speaking. So now there is an euphoria in the market here. The market is at a peak. And now you have disregarded your risk management. You are believing in the market will go up indefinitely. You are thinking, "Hey, this is it. It's going to keep on going up." And so you enter the market. Now you are extremely greedy and you are complacent. The complacency is about to follow. So this is where most retail traders will now buy at the top. And then, boom, you are believing the market will never fall. Now you ask me, but Cliff, if this is true, why then is it that people still fall for this? You fall for this because it's a psychological thing. You see, when we talk about the psychology of trading, it's not about techniques only. It's a revelation you need to have. You heard me saying this in the psychology of the, recognizing patterns, that if you find yourself seeing that fire is burning people, you wouldn't go near the fire because you have a revelation of what fire is. So psychology in trading should be able to help you understand the psychological aspect of every bit of the information you are learning so that you can apply them and survive. Psychology does not help you to make money. Psychology helps you to survive. I want you to see yourself as a trader, yeah. I want you to see yourself in the boxing ring. No boxer goes into the ring and go like, "Hey, you know what? I am never gonna get punches today." No boxer should do that, and no boxer will do that, and no professional boxer will ever think like that. Every boxer knows that they're going to get punches one way or the other. They know that they are going to get some punch, whether at their right side, the left side, their face. So their job is to block them. But their main goal is to make sure they don't get knocked out. But no boxer goes into the ring and be like, hey, I'm never going to get punches today. Well, there are some boxers that is their goal, but I'm saying on the most case scenarios, you don't go into the boxing ring thinking that you're never going to get some punches. Your goal is to make sure you don't get knocked out. Same thing in trading. Your goal is to make sure you don't get knocked out. Your goal is to make sure you don't blow your account so that every single time that you are surviving every day, there is an opportunity coming you can take advantage of. So your goal is to make sure the market doesn't knock you out. And that is where psychology comes in. So psychology doesn't help you to make money. Psychology helps you to survive while you're making money days is coming. What actually helps you to make money is called risk management because trading is a numbers game. Are you guys with me? So now you have disbelieved, you were hopeful, you still didn't take the trade, you were optimistic, you now believe late, and you became thrilled, and you became so like, it's about time we go for the home run. Then now the next thing we're gonna be talking about is anxiety and depression. And I want you guys to look at the chart very well. If you look at the chart, you will see that where the euphoria is, the market is gonna dip down a little bit. Now, when the market, you see the market dip down all the way to the disbelief, to the belief stage where you started to believe. You see that now? So the market has dipped down all the way to the belief area. Back to your entry. Back to your entry. So this is where you're supposed to be like, you know what? Oh man, uh, it's just a pullback. But yeah, and then the market will now push back again a little bit to make you complacent and be like, oh man, this is not really gonna drop. It's just it has finished correcting itself. Now we are going we are going to the moon, right? Then while you are still being complacent, one thing that you start realizing that it start dropping on you. This is the type of um times where people will say, hey, let me go take my shower and let me just go and come back. And by the time I will come back, I will get the move. Or maybe by the time I will come back, the price will be in profit. Right? So you go take a shower, the trade is in, and when you come back and you open your MT5 or MT4, there is this hope in you that it has turned into blues. There is this hope that if I open this chart, I'm hoping it's going to be blue. And it's not going to be blue. This is the one that you go to cook. And by the time you will come back, you are thinking it's going to be blue. But it's not going to be blue because you are not entering the trade with a structure. You are just hoping it will be blues. It's not going to be blue. True story. I'll never forget. One time I was praying and I knew I was supposed to stay away from the market anytime that I'm not in my office. But I've been waiting for this move for so long. And I got a notification, trading view notification, like bing, whatever alarm that you use. And then what happened was I took the trade and I said, oh, as for this trade where it has fallen to and I'm getting a notification, there is no way it will dip more. So of course I became hopeful in the wrong time. So I entered a trade. So when I entered this trade, I now went back into praise. So I was speaking in tongues. I'll never forget that day. I was in the spirit. And then while I was praying, I got a notification again on my trading view that shows that the market is going past the area I thought it wouldn't go. And instantly I opened my account and I started to see that I'm in a drawdown and I couldn't pray anymore. Because that moment, I mean, that is some of the things that as a believer who is in the spirit is supposed to see in the spirit. No, I'm kidding. But then I didn't see it. I'm not in a drawdown. And I'm like, wait, should I continue praying or I should go fix this damage? You know what I mean? I'm saying this to say that it's very, very important that you understand that you don't leave trading to chances. Whether if the move is ready and you're doing something, just finish whatever you're doing. If it goes, it goes. Or if you can sacrifice what you're doing to go pick up the trade, that is up to you. But you thinking this will not happen is an illusion. Sometimes we create for ourselves. Anything can happen in the market. You need to believe that. It's very, 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 very important. And so yes. So at the end of the day, and when we talk about this, that is why sometimes it's quite very interesting for me when traders are saying something like, and I always like, oh man, my risk to reward ratio is great. And I ask myself, I see those kind of comments and those kind of, videos or those kind of posts. And I go like, do you really know what risk to reward ratio means in trading? When we talk about risk to reward ratio, yeah, is really about understanding the psychology of risk to reward ratio in trading. What that simply means, if you come to me and you tell me, Cliff, my risk to reward ratio is 1:5. Psychologically, what you are basically saying is that I am okay with it if I lose 4 trades in a row because the fifth one could save me. Even if I lose 3 times in a row, the fourth and the fifth one could push me into profit. So if you now understand this and you go like, hey, Cliff, my risk to reward ratio is 1:10, great, good for you. What you are basically telling me is that I understand that I can lose 8 trades in a row and I'm still going to be okay with the ninth and the 10th one. It's like you find a lot of retail traders throwing words around with something they don't even get. So why would you tell me that your risk to reward ratio is 1:5 and yet you get angry when you lose 2 trades in a row? It doesn't make sense. Do you guys understand what I'm saying? Like, people don't understand the psychology of the things they talk about in the market. So if you say, oh, me, I love better risk to reward ratio, 1:5, 1:4, great, good for you. But you understand what you're basically saying is that I am okay psychologically to lose 2 to 3 trades in a row and I will still be good. That is what it means. Do you guys know that's what it means? Now I know. Now you know. Like that. Perfect. Now you know. So don't come and tell me, oh, Cliff, I met a trading guru. His risk reward ratio is 1:10. Then don't come back and tell me you are angry if the person is losing 2 to 3 times in a row. You should still be celebrating because he's 1:10 guy. There is a difference between anxiety and panic. Every time that you are anxious, you think too much. And anytime that you are panicking, you act too much. And your action is going to lead to some consequences you don't want. So as a trader, anytime that you are in a move that is making you panic, the first you need to ask yourself is, did I properly manage my risk? Because traders are not afraid of losses itself. They are just afraid of the size of the loss. Nobody gets angry if they lose a trade that didn't hit them hard. So, for example, if you have $500 and you lose $10 from that 500, you're not going to get as much angry as losing $200 from that $500. So it's not really about the loss that makes traders angry, it's the size of the loss. The panic is where they act. That means the panic is where you start to cut your losses. You didn't cut it, you were being complacent. You didn't cut it, you were being anxious. You didn't cut it, you were being denial. Now you are cutting it because you are panicking. Then the time that you are supposed to capitalize, you are cutting out of the trade. Then you are now angry, then you are now depressed, and it starts again from disbelief. So this is the psychology of a market cycle. It repeats itself over and over again. It starts from disbelief. You don't enter the trade, you become hopeful for no reason. You become optimistic and you enter at the wrong place and you are still thinking it's going to go to the moon. And it doesn't, and the cycle repeats itself. This is how retail traders allow themselves to be played. It's as simple as that. Because we forget that we trade who we are. You can learn all the skill in this industry and still not apply it because the you component part, there is something still missing in there. So you have heard me saying this before, that there are 3 types of management in this industry. Number 1, you need to learn how to manage risk and your capital, and then you. Very important. And so if you understand this psychology and you become aware of the market cycle being like this, eventually your actions will start following these things properly. So what that simply means that you will know that, man, why am I disbelieving in this move? If my system is telling me it could go there, then pull the trigger. Don't wait until it's too late and enter the trade and then come back being anxious and being denial and panicking and cutting it at the time that you're supposed to be preparing to enter the trade. Does that make sense? So this is the psychology of the market cycle. I hope you guys learned something today. Now that we have studied this psychology of the market cycle, or now that, everyone understands this psychology of a market cycle, when you are now studying market structure, it now makes sense. It now makes sense for you to study market structure in a way that can lead to an amazing, structure for you. All right, guys. So there you have it. another masterclass again. I hope you guys enjoyed it. I'm going to be doing this more often. So make sure you subscribe and do every single thing that YouTube wants you to do for me for this page to grow. By the end of this year, we are trying to hit 10K. So let's go.
Trading is